As you come into this meeting, you would have seen the announcement I posted right in the chat box, right? So basically, do not forget this Friday. That will be the last homework, okay, for you to do. Furthermore, right, I hope you have read the instruction for the midterm exam. Okay. What I try to do, right, I am actually writing the exam paper. Try to write the exam paper this morning, but still have not much idea about what to ask you in the exam. So that might take me a few days. So on Friday, I will post the template for the answer sheet, right? So that if you want to use that, you can just print it out, right? And use that as your answer sheet. But if you don't have printer, right, you can use blank A4 paper. That's fine, right? It might be easier if there are lines, right, in that paper, so that you can write your answer neater, right? But just make sure that the color of the paper is white, because after you submit, right, I will print your answer sheet and mark, right? I will not mark on screen. It's quite difficult. So after the exam, I will print all your answer sheets right out to mark. So if your paper is not in white color, I will waste a lot of ink printing your answer sheet. Okay, so make sure that the answer sheet you use, right, is white in color. Okay, but I provide you with the template, right, in case you want it. Right, this Friday I will post it. Okay. Most likely there will be 4 questions, right? There'll be 4 main questions in the exam, right? We can talk about that after the class. Okay. And the exam will be just 2 hours, right? Length, right? And then I add 10 more minutes, right, for you to have enough time to submit your answer, right? Okay. Let's start with the lecture note. Okay, we have quite a fair bit to cover, right, to finish. So what I want to do, right, I want to finish lecture 6, and I want to touch on very small part of lecture 7. Basically, in lecture 7, there is a part that talk about forward contract, right? So I think it's just a continuation from lecture number 6, right? So what I want to do is that I want to touch on that part as well, right, from lecture 7, right, so that we complete the midterm, right? And when we come back from the midterm, we start talking about foreign currency derivative and also interest rate derivative. That the major part of lecture 7. Okay, so let's continue from where we have left, right, last week. Just give me a second. Okay, I guess last week I was talking about how the foreign exchange market is organized, right? And then we talk about that the market is an OTC market, right? At the core of this market, right, there is a network, right, of commercial banks, right, who act as FX dealers, right, providing dealing, right, business, right, for those who want to exchange money, right, and they earn bid-ask spread, right, for that effort. Okay, and then I also say that, right, foreign exchange market can be divided into 2 layers, right? In the center, right, we have interbank market. This is where banks, right, foreign exchange dealer trade foreign currency with each other, right? As for the part that banks provide service to non-bank customers, right? We call that retail market. But most of the action, right? Most of the action in this market, right, occur in the interbank market. So if you understand how interbank work, right, you will also understand how the retail market work. Okay, right. And then I talk about the three main types of transaction, right? FX spot, FX forward, and FX swap. Okay, you must not confuse, right, this swap, right, called FX swap, to another kind of swap, right, which we will cover in lecture 7, right? You might have heard of interest rate swap, cross currency, and interest rate swap. These two swap contracts are similar, not the same, but similar, but they are different from FX swap. Okay, so FX swap it's quite different from the other two swaps. Okay, but I have decided that for undergrad, right, I want to only cover FX spot and FX forward, so I will not cover FX swap, right, for this subject. Okay, but if you look at the amount of transaction, the volume, right, this is the transaction with the highest volume, right? Normally, commercial banks use FX swap transaction to hedge exchange rate risk. Central bank also use FX swap as a tool, right, for FX market intervention. Okay, that's why the volume is quite high, right? And then I talk about market center, right, a pair of currency that are actively traded. Okay, and then I talk about the size of the market in Thailand. Okay, this is where I should start today, I guess, right? As I told you, right, there are three main types of function of transactions, right? Three main types of transaction. Spot transaction, right? Let me explain how spot transaction work. Okay, this is the types of transaction that is treated as a standard transaction or a benchmark transaction. So market participants basically use the exchange rate from this transaction as a benchmark when they want to refer to other exchange rates like forward exchange rate. Okay, so this is a kind of transaction that is treated as a benchmark transaction or the standard kind of transaction. Okay, so when you look at news report, right, on exchange rate movement in the market, they normally talk about this exchange rate, spot exchange rate. Okay, the exchange rate from the spot transaction is used as a reference rate, right, as a benchmark rate, right, for other types of transaction in the market. Okay, so I will use capital letter S to represent the exchange rate for this kind of transaction. Okay, and normally I subscribe the time, right, that the exchange rate is quoted as well. Okay, by definition, right, this is a transaction whereby currencies are traded for immediate delivery. But the term immediate here, right, has specific meanings, right? FX market is part of money market, right? This is part of the money market. So in money market, right, in Thailand and in many countries, right, when they said immediate delivery, what they actually mean is that, right, the transaction, right, that we enter today, right, will be settled, right, will be settled 2 business days later. So that means, right, if we trade time T, right, as what we call trade date or deal date, right, the date where the counterparty agree on the transaction, settlement date, which is also called as value date, occur 2 business days later. So the term they use is T plus 2. That is the value date, right? The settlement date, right? For spot transaction. Okay, and if there is a holiday in between that 2 days, right, we don't count holiday as part of the business days. So the settlement date will push forward, right, until we complete 2 days of a business days. Okay, let me show you an example. Assume, right, on Monday, 12 June, right, 2004, Citibank sold 5 million US dollar. So Citibank has a short spot position, right? Sale, right? Short spot position. Bangkok Bank, right? Purchase, right? And they agree, right, at the exchange rate of 40 baht per dollar. And because it is spot transaction, let's call this exchange rate as the spot exchange rate, so that we don't confuse with exchange rates from other transactions. Okay, so this is spot exchange rate. So if between Monday and Wednesday there is no holiday, then this transaction will be settled on Wednesday, 14 June. Okay, so on that settlement date, right? Settlement date, Citibank have to deliver 5 million. Bangkok Bank make a payment of 40 baht per dollar, so that's 200 million baht. You can see that all these numbers, right, they are fixed since 12 June, right? The counterparty only have to wait for 2 days, right, to settle the contract. Okay, so like for example, if we agree on 22nd of November, so that is the trade date or due date, right? The value date, right, or of the spot transaction, right? The value date of the spot transaction, right, is the date where we settle the contract, right? Occur 2 days later. Okay, but as I said, right, we only count business days, right? So if there is a holiday in between, then we push, right? We push the value date, right, forward. So if you and I, right, agree on a spot transaction, right, and we enter the contract on Friday, right? If we enter the contract on Friday, right, then we have to settle that contract next Tuesday. Okay, that's how we count, right, days, right, of the settlement. Okay, right. Next, you can notice that if we want to enter into a spot transaction, right, we have to prepare, right, at least 2 days in advance. So if I want the money today is Wednesday, that means I must enter the contract, right, on Monday, right, so that I can have the settlement, right, on Wednesday, right? So if we want to enter spot contract, that means we have to do enter the contract, right, 2 days, right, before we actually need to use the money, right? Sometimes, right, counterparty might realize that they actually want the money now, right? If they want to enter into the contract, right, for the same day delivery, meaning that the day of the contract and the delivery date, right, are on the same day, right? That is another kind of contract called today transaction. So if you suddenly want to use foreign currency right now and you didn't do it 2 days beforehand, so you just have to go to the bank and tell the bank that you want to exchange money, right, for same day delivery, meaning that you want the money now, right? The bank will treat that as a today transaction and quote you another exchange rate called today exchange rate, right, which could be different from spot exchange rate. If you want the money next day, tomorrow, right, but you enter the contract today, right? In that case, the bank will treat this as a contract, right, or a transaction known as tomorrow autumn transaction, right? And the bank will quote another rate for you, right, called tomorrow exchange rate. Okay, so whether you are doing spot today or tomorrow, right, we enter the contract today, right? It's just that delivery date of these three transactions are on different days. and therefore their exchange rates could be different. Okay, spot transaction, right? Among these three, right? Spot transaction is the one that has the highest volume, right? And we treat exchange rate from this transaction as the benchmark, right? To quote today exchange rate, tomorrow exchange rate, and also forward exchange rate. Okay? The main reason why we need 2 days to settle the contract is that if you think about clearing check, right? If you have check of one bank, right? Bank check, and you want to withdraw that money, right? But I mean, you want to place that check, right? From one bank, right? But want to place that check to deposit account with another bank, right? Normally it takes 1 day, right? To clear the check, right? If you place the check after certain time of the day, right? You have to wait 1 more day to get the money. And that is same currency, right? One currency. So when we deal with foreign exchange transaction, right, we are dealing with 2 currencies. Therefore, we are dealing with 2 financial centers. So if we do baht dollar, then Thai baht will be settled in Bangkok, but US dollar have to be settled in New York. And because of the time zone, right, that's why we need 2 days, right, to settle this type of transaction, right? If you happen to be in Canada, right, and you want to exchange between Canadian dollar and US dollar, right, and you are in Canada, right, there, right, spot date between dollar, right, Canadian and US, right, they settle in 1 business day. That means T+1. That is because they are in the same time zone, right? But we are in Asia, so most likely we are dealing with T+2 almost all the time. Okay, so that's the convention. Now let me explain the second type of transaction known as forward contract. Okay, this is a transaction where counterparty agree to trade, right, between 2 currencies today, right? But they will settle the contract, right, at a specific date in the future. So what happened with the forward contract is that counterparty agree to buy and sell, right, certain amount of foreign currency against home currency, and they agree in all details of the transaction now. It's just that the actual settlement have to occur at a specific point in time in the future, right? So this is called forward contract. Right, so we enter a contract for future delivery or for future settlement. Okay, right. Let's see how this is done. Right. Assume, right, on the 1st of April 2004, ABC sells $5 million US, 3 months forward. One thing you should notice is that when we talk about spot transaction, we don't have to talk about the tenor, right, or the time to maturity of the contract, because it is always 2 days. But when we talk about forward contract, right, to have a complete information, we must talk about the tenor, right, or the life, right, the length of the contract, right? So in this case, right, ABC sells 5 million 3 months forward, right? If you just said forward contract, that is not complete information, right? So in forward contract, we have to specify the time to maturity, right, or the delivery date of the contract. So this contract will deliver in 3 months' time from the date of the contract. I mean, the date of entering the contract. Okay. So 3 months forward, right? Assume that the counterparty and ABC agree to trade at 38 baht per dollar. So let's call this, right, because this is exchange rate in 3 months forward contract. So let's call this 3 months forward exchange rate. Okay, what happened is that, right, that is the time of the agreement, right, that they do the transaction on the 1st of April, right? Now, delivery date, okay, delivery date of these transactions, right? Because spot transaction settled in 2 days time, right? Spot transaction settled in 2 days time. So when we count number of days in this kind of contract, forward contract, we have to start counting from spot date, not from the trade date. Okay, so the trade date is 1st of April. So 1st of April, spot date of 1st of April is 3rd of April. So that is the spot date, right, from the due date. And then we start count, right, the length of the contract from 3rd of April. So this is 3 months forward, right? What they do in the market is that they just count month to month. So spot date is 3rd of April, and therefore 3 months later, that would be the 3rd of July. So that would be delivery date. So ABC sales, so ABC must deliver 5 million. And in return, we will receive, right, 38 baht for each dollar. And that's how the contract is settled, right? And this kind of contract creates obligation, right, to settle, right, on both sides of the transaction. Okay, so it doesn't matter what exchange rate is in the future, right? This settlement must occur. 1st of April is the due date, correct? The 1st of April is the due date, correct? Okay. I'm not sure whether I have some, right? That's the due date, right? But when we count, right, even though this is 3 months, but we don't start counting the life of this contract from the due date, right? We start counting the life of the contract from spot date, okay, and then count for 3 months, okay, right? If the 3rd of July is a holiday, then we push forward, right, 1 day, right, until we find a business day to settle. Okay, that's the convention that you should understand, right? So this is forward contract. Okay, FX transaction, FX swap transaction, right? I would like to skip. Okay, so don't worry about this. It's actually a combination. Actually, this contract is a combination between spot and forward combined into one agreement, or it can be forward and forward combined into one agreement. It's called FX swap. Okay, actually, this transaction could be quite useful. Okay, if you have certain kind of exposure. Okay, but let's ignore it. Okay, don't worry about this then. Don't worry about this as well. Okay, right. These tables, right? These tables show you interbank exchange rates. Okay, so I collect this from Reuters system, right? On the 22nd of March 2003, right? That table show you the exchange rate between Thai baht and US dollar. Okay, so that is the exchange rate for spot transaction. Then they also have exchange rate for today transaction, tomorrow transaction, and forward transactions, right? All these rates are quoted at the same time, right? But the numbers are different, right? Because the delivery dates are not the same for across these transactions. On the right hand side, right, I show you the AEC currencies against US dollar. Okay, I hope you know, right, this symbol, right, represent which currency, right, in the AEC countries. Okay, so I want to leave this table to you, right? You might notice that the exchange rate, right, of Brunei dollar against US compared to Sing dollar against US dollar, the rates are exactly the same. Okay, that is because there is a fixed exchange rate between the two currencies, right? Right. Okay, let's move on to market mechanism. Oh, the reason why these rates are different, right? The reason why all these rates, right, are different, right, has to do with um, the interest rate between the two currencies. That has to do with interest rate between the two currencies, right? That cause forward spot today and tomorrow exchange rate to be different. Basically, it's due to interest rate differential, right, from the IRP relation. Okay. Another reason why today looks actually, if you look downward, right, exchange rate start from low to high, right? But this one jump a bit. You have to understand that these two transactions are not as liquid as spot transactions. So sometimes because of the lack of liquidity, right, bank will charge some kind of risk, right, into the exchange rate, right, to counterparties, right. That's why the movement should be monotonic, right? Right. If tomorrow is cheaper than spot, then forward should also be more expensive than spot, right? But it's not monotonic for the today exchange rate. That could be due to some kind of market friction, right? Okay, but the difference across forward and spot rates, right, have to do with interest rate differential, right, between dollar and Thai baht interest rates. Okay, right. Here, right, I will talk about the market mechanism, and why I will also talk about how commercial bank come up with exchange rates, right, to quote to retail customer. Okay, you might go back to understand this table better, right, after this. Okay, um, this is about market mechanism. I will use spot transaction as example, okay, to explain all this, right. Um, Later on, right, you will see that dealing with exchange rate can be quite confusing because when we buy one currency, we have to save another currency. So it's always opposite, right? So that can cause confusion very soon. Okay. Um, this is the way FX dealer look at exchange rate so that there will be less confusion. Okay. We know that exchange rate is simply the relative price between two currencies, right? So if you look at the exchange rate, this one, and compare this exchange rate, right, with price of a car. Let's think about price of a car. So price of a car is, say, 500,000 per car, right? So you can see that actually it's actually just relative price, just like price of anything, right? Any product. But what exchange rate can give you confusion is that both the price and the product, they are currencies. But in normal price, right, you have money and product. But in exchange rate, you have money against money. That's why later on it's going to be confused, right? So this is how FX trader, right, or dealer, right, treat exchange rate so that they don't get confused. Basically, in an exchange rate, there are two currencies, right? In an exchange rate, there are two currencies, right? Dealer look at the two currency as one being commodity, another one being the term. So in an exchange rate, right, one currency acts as commodity or base currency. Another currency acts as the term, right, or quote currency. Okay, commodity currency is the currency that is being priced, right? Commodity currency is the one that is being priced. Term currency is the one that we use as unit of account. Now, in this exchange rate, can you tell me which currency is used as commodity and which currency is used as term? Right, 34.65 baht per dollar. Right, we are talking about dollar being the commodity, right? Because commodity must have one unit, right? Right, and the amount of another currency that is used as price or term, right? So, or unit of account, right? So in that exchange rate, right, the commodity currency is US dollar and the term currency is Thai baht. Basically, the currency in the denominator is commodity, just like the car, right? The currency is in the numerator, that is the one that is used as unit of account or term. Okay, now that's how we treat an exchange rate. Okay, next. Normally, when we write exchange rate in textbook, right? When we write an exchange rate in textbook, right? Let me call this as the textbook language. Okay, we write exchange rate this way, right? 34.65 baht per dollar. That's how we write exchange rate. Basically, we write exchange rate as a ratio number, right? Or a fraction number, right? So that slash sign is actually a division sign, right? That slash sign is actually a division sign, right? But that is what we use in textbook, right? But if you go to the industry, financial industry, that is not how they write exchange rate, right? When FX trader quote exchange rate among themselves, right? What they do is that they will mention commodity currency first, followed by price of that currency. So in that green box, that is how exchange rate is written in foreign exchange market. Okay, commodity currency comes first, right? Followed by its price in terms of another currency. So in this kind of quotation, the slash sign, that is not a division sign, right? That slash is used just to separate the two currencies from each other, right? Unlike our textbook language, okay? So throughout this lecture note, I want you to be familiar with how they quote exchange rate in the market. So I will use this kind of quotation, okay? But from time to time, when we have to deal, when we have to manipulate, right? We have to do mathematical manipulation of numbers. I will come back to this kind of writing because writing exchange rate in textbook language is easier to deal with when we have to do mathematical calculation. Okay, right. So most of the time in the rest of this lecture, right, we use this kind of quotation in industry. Okay, next. We know that, right, in an exchange rate, there is a commodity currency and a term currency. The question is there any convention to determine which currency to be used as commodity and which currency to be used as term? Because without the convention, right, quoting exchange rate can be quite confusing. If one party use dollar as commodity, another party want to use dollar as term. So when they negotiate the trade, it will be very confusing, right? Apparently, there are conventions, right? There are conventions in the market, right, on how to determine, right, which currency to be used as commodity and which as term. Okay, I want to separate foreign exchange market into two types, right? The first is domestic market, right, where bank treat non-bank customer, right? Another layer is the interbank trade, and this is also referred to international financial market, when one bank trade foreign currency against another bank, both inside and outside the country. Okay, but when bank trade retail customer, that's most likely it will be just domestic market. Okay, now let's look at how bank quote exchange rate to domestic customer first. Okay, there are two systems, right? There are two systems for this. Okay, and the most popular system that bank use to quote exchange rate for non-bank customer in domestic market is the system called direct quotation. This is the quotation system that is used, right, in most countries in the world. Basically, in direct quotation, we treat foreign currency as commodity. We treat home currency as term. So we quote, right, home currency price per 1 unit of foreign currency. That is called direct quotation. So if we are in Bangkok, right, when we quote exchange rate, we quote number of Thai baht per 1 unit of foreign currency. So that's direct quotation of foreign currency in Bangkok. Okay, most countries in the world use this system, treat foreign currency as commodity, right? But there are exceptions. There are exceptions, right? The exception, right, is that for a small group of countries like Great Britain, right, Australia, New Zealand, right, and the Eurozone, right? These countries, right, when banks quote foreign currency, right, to domestic customer, they use the opposite system called indirect quotation. In this quotation, we treat home currency as commodity and quote the number of foreign currency per 1 unit home currency, right? For example, indirect quotation of the euro, right, in Bangkok, right, is that we treat Thai baht as commodity, right, and give the euro price per Thai baht, right? But Thailand, we don't use that, okay? But in Eurozone, they use this system. So they would quote, right, number of other currency per 1 unit of euro, right? So in Australia, right, if you go to Aussie Bank, right, what they quote is that they will quote number of foreign currency per 1 Aussie dollar, right? That's indirect quotation in those countries. Okay. In Thailand, we use direct, which is for me a lot easier to understand. Okay. But when it comes to interbank and international trade of foreign currency, there will be no home currency anymore, right? Because if bank in Japan want to trade foreign currency with bank in Bangkok, right? Because they are in different countries and therefore they have different home currencies, right? So when it comes to interbank trade, right, or international trade, right, of currencies, right, we cannot treat any currency as home at all, right? Otherwise, it's going to be confusing, right? But luckily, right, in the interbank and the international trade of foreign currency, right, there's one currency that dominates about 90% of the time, right? We always trade that currency, right? That is the US dollar. Therefore, in the interbank trade, right, and internal trade of currencies, right, we normally quote currency price against US dollar because US dollar is the most traded currency, right, that occur about 90% of the time, right? 90% of FX trades, right, always have US dollar involved, right? But that number might drop, right, as time passes by, right? As other currencies start to gain significance. Now, with this kind of quotation against US dollar, there are two systems, right? The first system is called American terms. So most currency when traded against US dollar, right? For most currencies when traded against US dollar, right? Banks quote them in sorry, I said it wrongly. That should be European term, right? But let me explain American term first, okay? American term, right? This is not the most popular approach, right? American term. American term, right? As the name suggests, right? We use US dollar as term currency, right? And treat other currencies as commodity. This is American term. European term is the opposite. European term, right? We treat dollar as commodity and other currency as term, right? As I told you, right? Dollar is the most active currency to be traded. So therefore, when we quote dollar against other currency, it is more convenient to use European term. Use dollar as the base. For example, right, exchange rate between Japanese yen and US dollar could be 100 yen per dollar. And exchange rate between Thai baht and dollar, right, could be quoted at 30 baht per dollar. Now, when I want to compare exchange rate between Thai baht and yen, right, when the two currencies use European term, it's a lot easier to compare, right? Because we know that this amount of Thai baht, 30 baht, and this amount of Japanese yen, 100 yen, they have the same dollar value. So if I just take the division between the two, dollar will just disappear. And now we get exchange rate between two non-US dollar, right? So no wonder in the world, right, when we quote US dollar against other currencies, we tend to use European term, right? Because dollar is the most active traded currency. We better treat it as commodity, right? But as we know, right, there are always exceptions, right? So for a small group of currency, right, when quoted against US dollar, banks will use another term called American term. And that group of currencies happen to be the same group of currencies that use indirect quotation in their own country, right? Look at their currency as base, right? So that includes the euro, right? So if you notice, right, when you see exchange rate between dollar and euro, right, bank will quote number of US dollar per euro, basically use American term, right? The pound as well, right? Aussie dollar, New Zealand dollar, Irish pound, for example. Okay, so that's how, right, FX dealer, right, determine, right, which currency to be used as term and which currency to be used as commodity. Okay, now let's try to figure out. Okay, let's try to figure out, right, which column is American term, which column is European term. Okay, in this table, I show you exchange rate between foreign currency. The name appear in the first column, right, against US dollar, right? But this table show you two quoting system, right, for each currency. I want you to identify which column represent American term and which column represent European term. To answer this, I think the best way is just to pick up one currency that you are most familiar with. For me, I think Japanese yen is quite easy to understand. Okay, I got the answer. That's right. Right. Thank you, Kun Thanadon. That's right. A is American term. B is European term. Because if you look at column B for Japanese yen, that is number of yen per dollar for sure, right? So that is European term, right? A is American term, right? So now you know which column represents which quotation system, right? Next, I want you to help me right? To identify for each currency, which system do we use, right, in the interbank market? Okay, Aussie dollar, which column do we use? Aussie dollar. When bank quote Aussie dollar against US, that's right, we use A, American term, right? Danish kroner, Danish kroner. Danish kroner is not part of the exception, so we use European term. Okay. Japanese yen. Japanese yen is European term, right? And what else? Ringgit. Ringgit, European term, right? British pound is part of the exception, right? Swiss franc, European. The euro is the exception. Okay. And if you trade foreign exchange, right, you will kind of remember all this, right? That's how when we read Reuters screen last week, we know how to read the numbers, even though there is no indication of which quotation system being used, right, in each number. Okay. That's how bank quote, right, exchange rate between two currencies. Okay. Next. When commercial bank quote, right, exchange rate to customer, right, they will quote, right, two numbers for each pair of currency. Okay, so when FX dealer quote, right, exchange rate, right, they use two-way pricing, right? Basically, they will quote buying price and selling price together for the customer. Basically, as a customer, you don't have to tell the bank, right, whether you want to buy or sell, because they give you two prices anyway. Okay, so when FX dealer quote exchange rate to customer who asks for the quotation, right, the dealer will quote, right, two prices, right, for each pair of currency, right. The first price is called bid price or bid rate. The second number is called the ask rate. And if you notice, bid is always cheaper than ask. The difference between these two prices is called bid-ask spread. Okay. Let me define the term first. Okay. Bid price. Bid price is the price that the quoting party is the dealer, the one who quote the price, right? Bid price is the price that the quoting party is willing to buy, right, commodity currency from counterparty. That is the meaning of bid, right? Ask is the price that the quoting party is willing to sell, right, commodity currency to counterparty. Now, at this point, I think it is appropriate that I introduce you to two terminologies. Okay. The first terminology that I want to introduce is market maker. Right. The second terminology that I want to introduce here is market user. I think this term will make it clearer when we talk about which bid, whether we use bid or ask. Okay. Market maker is the one that quote the price. Market user is the one that use the quotation, or the one that asks for the quotation. So why I have to introduce these two terms? Because sometimes dealer can also be market user. If, let's say, right, I am dealer from bank A, right? I have foreign currency that I want to sell, right? But I want to sell to another bank. So in this case, I have to call another bank, which is also FX dealer, right? And ask them to quote me the price. So in that case, right, the other bank is the one that quote the price, right? We call market maker. As for the one that received the quotation, me, I am the market user. Okay. Now in this example, right, I assume that customer asks for quotation. So in this case, the customer is the user, and the bank is the one that make the market, right, quote the price. When we define bid and ask, we define from the perspective of the market maker, right? We define these two terms from the perspective of market maker. So as a customer, if you want to sell foreign currency, as a customer, if we want to sell commodity currency, we have to sell at the rate they want to buy, right? We have to sell at the rate that the quoting bank want to buy. That is bid rate. So Thai exporter normally have to sell foreign currency because they have foreign currency income. So Thai exporter, right, normally deal exchange rate on the bid side, right? Because they want to sell, they have to sell at the rate the bank want to buy, right? Thai importer, right, has foreign currency debt, right, account payable, right, but Thai baht income. So most likely Thai importer need to buy foreign currency to pay debt, right? So in this case, they end up use ask rate most of the time. Okay. I am quite slow here because I don't want you to pick the wrong side, right? That will be silly mistake, right? To pick the wrong side. Okay. Right now, you know how to define, right, which side of the quotation, right, which party use. Okay. Let's try some example. Okay, but before I move on, um, right, let's say, right, this is bid and ask price between US dollar and the euro, right? In interbank market, right? In the interbank market, when dealer quote foreign currency exchange rate against each other, they normally do not quote exchange rate in full. When you quote exchange rate in full like this is called outright quotation. But we know that this market is very liquid, right? Time is precious. So when dealer quote exchange rate between themselves, right, they will not quote in full because that wastes time. What they do is that, right, they will quote the bid price in full first. As for the ask price, they just ignore repeating numbers. Right? So the last two digits, that is the difference between bid and ask, right? Dealer call it as pips or points, right? And the number in front, they call it as large number. You know, this is still quite the quotation is still quite a lot, right? In reality, when dealer talk about exchange rates between themselves, they don't even mention the first three numbers. They just mention the last two digits, right? Assuming that the other side know what are numbers in front. Okay, so that's how dealer quote exchange rate, right? When they trade. Okay, let's. Oh, I still. Oh, one more slide before going to the example. When we want to swap base currency, right? Here, right? I have number of Thai baht, right? This quotation, right? US dollar is commodity, Thai baht is term. So that is number of Thai baht per dollar, bid and ask. Now, from that exchange rate, right? If we want to swap base currency, basically we want to swap the quotation system, right? From Thai baht being term into Thai baht being commodity, right? We know that we have to take reciprocal, right? We know that we have to take the reciprocal of the original exchange rate. But what you have to be careful is that when you take reciprocal, you also have to switch between bid and ask. Do not just take reciprocal, right, and say bid, right? Take reciprocal of bid into bid of another quotation, right? That is not the case, right? When you take reciprocal, right, to switch the quotation, right, you have to switch bid and ask price as well. Okay, so ask of the original go to bid of the switch quotation, right? Bid go to ask. Okay, why we do this, right? Quite simple. Let's say, right, if a customer wants to buy US dollar, right? A customer wants to buy US dollar. So the customer have to use this rate, right? Now, when customer buy dollar, that same customer must also sell Thai baht. Now, if you focus on the selling Thai baht, right, and look at this quotation, Thai baht is commodity. So if the customer want to sell Thai baht, the customer have to sell at the bid price. Right? Have to sell at the rate the bank is willing to buy Thai baht. But buy dollar and sell Thai baht are just exactly the same transaction, right? Buy dollar and sell Thai baht. This is the same transaction. So if they're the same transaction, they must come from the same exchange rate, right? So these two must come from the same exchange rate, right? Okay, so don't forget, right? Whenever you take reciprocal of bid and ask price, you have to switch that role, right? Of bid and ask as well, right? Otherwise, you will get wrong calculation, right? And wrong quotation. Okay. Okay, let's try this example. Okay, let's try this example. A bank, right, quotes the foreign exchange rate. Okay. Now, here, right, the exchange rate that I show you here, it is not in outright quotation. So better put them into outright quotation before doing anything, right? To reduce the chance of mistake. So bid, okay, let's put the bid price in full and the ask price in full first. 33.46 dash 33. Okay, 0.55. Okay, we have just 3 questions to do here. First, the customer wants to buy 1 million. Right, the customer wants to buy 1 million. I wonder how many Thai bahts does it cost, right, for the customer to buy 1 million. Basically, the customer wants to buy 1 million US dollar and sell Thai baht. Okay, so we start with 1 million. Since the exchange rate is quoted as number of Thai baht per dollar, therefore we know that we have to multiply, right, by the exchange rate. This is why I prefer writing exchange rate in textbook kind of language. because when we do mathematical operation, it's easier. So number of baht per dollar. You see that after we multiply that two amount, right? The dollar and dollar will disappear, right? Only have Thai baht left as the final answer. Okay. So first question, the customer want to buy dollar. So have to buy at the rate the bank want to sell. Therefore, that should be 33.55. Okay, you do final calculation by yourself, right? Now, second question. The customer want to sell 3/4 of a million US dollar, right? And how many Thai baht, right, would he receive? So we start with 3/4 of a million, right? We want to convert this into Thai baht. So again, we know that we have to multiply by the exchange rate that is in number of Thai baht per dollar. Doing that, we will end up with Thai baht. Now, in the second question, the customer wants to sell. So if the customer wants to sell, the customer have to sell at the rate the bank want to buy. Right? Have to sell at the rate the bank want to buy, which is big, right? So that is 30. Sorry. That is 33.46. Right? And then you do the final calculation. You can see that if the bank is lucky enough, right? A customer come in to sell $1, and then another customer come in to buy that dollar from the bank at the same time. In that case, the bank will earn the difference between these two prices, called bid-ask spread. Okay. I'm not sure what you mean. Kun Anja, can you tell me what you mean? Can you say at least the number in the reciprocal?
อาจารย์ค่ะ I'm not sure if there is a number in the denominator here.
Which one?
The
the one that I write here, right? Here, right?
3.55. Yes,ค่ะ.
Oh, that's dollar. That's it. Because the exchange rate.
$1, right?
That's right. It's $1. That's right. Because dollar is commodity, so it's only one unit of dollar in the denominator. So that's why that will disappear. Right. So that denominator has only $1. Okay. Right. The bid-ask spread that I just mentioned, right, is the profit that the dealer expect to get from providing these kind of services. But you have to understand that this bid-ask spread is not risk-free. It is risky for the bank. The reason being that normally exporter and importer will not go to the bank at the same time. So sometimes the bank purchase foreign currency in the morning and have to wait until the afternoon to sell. Right? If you think about cars dealer, that even works, right? They purchase car and wait for almost a year to sell. And you know that as time passes by, price change. So exchange rate can go up or go down, right? When the banks are waiting for squaring the position, right? So that bid-ask spread is not risk-free, right? It is risky, right, for the bank. Okay, so bank must have some kind of strategy, right, to deal with the risk issue here, right? I talk about that later. Okay. As for the customer, right? We treat bid-ask spread as transaction cost, right? We treat that spread as transaction cost. So when we pick banks, right, to buy or sell foreign currency, we choose the one that gives us the narrowest, right, bid-ask spread, because that implies the lowest transaction cost. Okay. Okay. Last one is interesting. The customer want to sell 4 million baht. So the starting point is 40 million baht. Now we have to convert this, right, into US dollar. Since the exchange rate is quoted as number of Thai baht per dollar, we know that to do that conversion, we have to make a division. Right, we have to make a division, right? And then baht and baht will just cancel each other, right? And dollar go to the numerator, become what we want to achieve. The question is which exchange rate to use here. The question is which exchange rate to use here. Now, the customer want to sell. So if the customer want to sell, right, the customer have to sell at the rate the bank is willing to buy. That is the bid. So that will be 33.46. But if you think about the two numbers again, right, the exchange rate, if the bank used 33.55 to do the calculation, the bank will pay less dollar to the customer, right? Using the bid rate for this calculation, right? Using the bid rate for this calculation imply that the bank have to pay more dollar, right? Compared to using the ask rate. So something must be wrong, right? Something must be wrong, right? Bank shall use the rate that lead to paying less, right? Not paying more, because bank have to make profit. So there is something wrong with 33.46. It's not correct. Why? When the customer want to sell, they have to sell at the rate the bank want to buy. And that's bid rate. But I said it is wrong, right? Why? That is because when we buy one currency, we have to sell another currency. So we have to look at the exchange rate that the bank quotes and then ask ourselves first, right? Which currency is commodity here? Which currency is commodity here? Dollar. So that exchange rate is quoted for US dollar, not Thai baht, right? That exchange rate is for US dollar, for buying and selling US dollar, not Thai baht. So to correct, right, to get the correct number, right, we have to focus the transaction, right? We have to focus this transaction from the perspective of commodity currency, not Thai baht. Otherwise, you get confused, right? Since the bank quote dollar as commodity, so we have to ask the customer, what does he want to do with the dollar? So in this case, he want to buy, right? He want to buy dollar and sell Thai baht. So if he wants to buy dollar, in the bracket, sell Thai baht, then it must be asked. And this will be correct. Right? So understand commodity currency, term currency is quite important, right? To reduce, right, confusion later on. Okay. Right. So from now, right, you shall not pick the wrong one. Okay. That will be in the quiz, I think, the homework, right? I asked you to do this kind of things, right? To make sure that you got it right before the exam. Okay. Next. Okay, this is important, and this part could be quite difficult to understand. Okay, so be patient. In this slide, I would like to summarize, right, how FX dealer obtain exchange rate quotation to give to the customer. Basically, think about a situation when a customer call bank, right? Ask the bank that, can you give me exchange rate for US dollar? So the dealer must come up with price and ask price, right? And quote to the customer. So in this slide, I try to summarize what happened, right, in that process to obtain the quotation for retail customer. Okay. Let me use a blank page, right, so that you understand the process better. Okay. Assume, right? A customer called the bank, retail customer called the bank, asking for exchange rate quotation. So when we quote exchange rate, right, we have to base the quoted rate from the current market condition, right? We don't use historical price, right, to quote current price, right? We have to use current price to quote current price. So when the customer call the bank, FX dealer, we have to check, right, the price from the market that is the most liquid. So basically they check, right, Reuters screen, for example, right, to check the recent exchange rate in the interbank market. So let's say, right, these are the bid and ask that the dealer obtained from the interbank. Normally in the interbank market, right, the bid-ask spread is quite low, very narrow, right, 1 stand or 2 stand only, right? But let me put it 4, right? So that would be the bid rate and the ask rate. Okay, B for bid, A for ask in the interbank. Now the dealer have to use that rate, right, as the basis, right, to quote to retail customer. Now I wonder which range should the bid price and ask price for retail customer be in. Okay, let me divide this into zone, right? Zone number 1, zone number 2, and zone number 3. I want to know where should bid price for retail customer be located, which zone? Where should the ask price, right, for retail customer be located, right, in which zone? Okay. How about we start with bid first? Bid price. Bid price is the price that, okay, bid price will be in zone 3, correct? Bid price will be in zone 3, and ask will be in zone 1. Okay, let me put that in first. Thank you for the answer, right? So bid should be somewhere here for retail. Okay, ask should be in zone 1, somewhere here. Okay, here is the reason. Here is the reason. Bid rate first. This is the rate that dealer will buy foreign currency from customer, right? This is the price that that the dealer will buy foreign currency from the customer. Now we know that as dealer, we don't want to speculate. As dealer, we want to buy and sell equal amount, called square position, so that we earn bid-ask spread for sure, or as safe as we can. So the business of dealing is not to take risk, right? Not to take price risk, exchange risk, right? The business of dealing is to square position as quick as we can. So if we buy foreign currency from the customer, the quickest way to get rid of foreign currency that we get from the customer is to sell it in the interbank market. So if we have to sell foreign currency in the interbank market, we become the market user. Therefore, we have to use the bid price from other banks as the price that we can sell foreign currency for. So if we can sell at 30.1, when we buy, we have to buy less than that, right? From retail customer. Therefore, bid must be lower than 30.1. Ask price. Ask price for retail customer. This is the price that we sell foreign currency to the customer. So to sell foreign currency to the customer, right? We have the cost of obtaining foreign currency to sell. So if I sell dollar to the customer, I have to replenish my stock, right? By buying dollar in. And the quickest way to buy dollar is from interbank. So I shall treat this 30.14 as the cost of obtaining dollar to sell it to retail customer, and therefore the price we charge must be higher. Okay, so that's how bid and ask in retail market shall be located. Basically, it should be wider. It should be wider than interbank market, but they can share the same midpoint, right? They can share the same midpoint, right? Okay, that's the general idea. Okay, now let me show you the details of how banks think about it. Okay, that's just a general idea. Okay, but in detail, right, there is something more going on in the trader's head than just this one. Okay. Okay, let me talk about how to set up the price in a little bit more details. And this is normally happen. What happened is that when a customer call dealer to quote exchange rate, the dealer will check interbank rates as in this picture, right? But once the dealer get bid and ask from interbank, the dealer will calculate midpoint first, right? So here, right, the midpoint is 30.12. Then the dealer have to ask himself whether he want to quote the same midpoint to retail customer. Why would the dealer want to trade midpoints that deviate from the interbank market to retail customer? There are a few reasons, right? There are a few reasons. The first reason is has to do with the dealer's foreign exchange position, right? The first reason has to do with the dealer's foreign exchange position. If throughout the days, the dealer has been purchasing a lot of foreign currency without, right, restate that again. If throughout the days, right, the dealer has been buying a lot of foreign currency without selling. So at this point in time, the dealer would like to sell more than buy, right? Because the dealer want to secure position at the end of the day. So if the dealer want to sell more than buy, the dealer will be willing to drop the midpoint a little bit, right? Because by dropping midpoint, we drop both bid and ask. So when we drop both bid and ask, right, as for the bid rate, that will give less incentive for customer to sell foreign currency to the dealer, which suit the dealer requirement, right? It doesn't want to buy anymore, it want to sell. But ask price drop means that give incentive for customer to buy from the dealer, right? So current exchange rate position could be the factor that cause dealer, right, to choose the midpoint that deviate from interbank. Another reason will be the dealer's exchange rate forecast, right? If the dealer believe that in the future exchange rate will drop, that means today the dealer want to sell more than buy. In that case, the dealer will drop the midpoint a little bit, right? from the interbank market. Okay, so after the dealer come up with the appropriate midpoints, the next step is to build in bid and ask spread. And there are few factors that affect how the dealer will add bid ask spread into that midpoint, right? Different currency would have different bid ask spread, mainly due to liquidity. A currency whose liquidity is high, right? Dealer will to quote narrower midpoint than the currency with less liquidity. Because if you buy currency that is not liquid, you don't really know when you can sell it, right? So you will have a good chance of selling at a loss. So we have to save ourselves by building wider bid ask spread, right? For illiquid currency. For the same currency at different point in time, bid ask spread could also be different. That has to do with volatility, right? So if the exchange rate is volatile, right, the risk is high, therefore dealer will add more bid ask spread, right? Compared to when the volatility of the exchange rate movement is narrow. Same currency, same point in time, but different customer. Dealer also charge different bid ask spread, right? Because customer have different level of risk. So if the customer has high level of risk, right, dealer will add more spread. If the customer trades small volume, dealer also charge wider bid ask spread. But if customer want to trade high volume, right, big amount of foreign currency, then dealer would be willing to narrow the spread, right, because the volume compensate for narrower spread. Okay, so these are things that affect the quotation, right? Okay, next. Before we go for the break, let's look at this table first, right? Then we go for the break. Okay, the reason I want to look at this table is that I found something interesting from this table. This is a table that shows you counter exchange rate, right? Bank call this as counter exchange rate or counter rate. If you go to the bank, right, you see behind the bank counter, there is a big screen, right, in branches of bank, right? This is the exchange rate that's shown in that kind of screen, right, called counter rate. It is actually, in our language, this is today, this is exchange rate for today transaction. Basically, counter rate means exchange rate for today transaction, right? Trade now and get foreign currency now. As tourists, you normally deal with this kind of exchange rate. Okay. What I found interesting from this table is this. Okay. These are exchange rates between Thai baht and US dollar. Okay. Thai baht versus US dollar. Let's focus on US dollar. Okay. Ignore the rest. Okay. Two things that I found interesting from this table. First, the exchange rate that bank quote to customer depends on the form of money that the customer use, the form of money, right? If we use banknote, right, bid ask price are here. But if we use bank check, right, or bill of exchange, right, bid price are here. Ask price are here, right? That include telegraphic transfer. Okay, so the exchange rate we get for the same currency, same amount, depends on the form of money we use. And you can see that banknote, right, get the worst pricing. Banknote get the worst pricing from the perspective of customer. For example, if I have 1,000 US dollar in banknote to sell, I get this rate. But if my $1,000 is in the form of traveling check, right, not banknote, traveling check, or bill of exchange, I can sell at a better price. Can you see that? So banknote pricing quite bad, right, compared to bill of exchange. Or if I want to buy banknote from bank, if I want to buy banknote from bank, $1,000, this is the price I have to pay. But if I tell the bank that I want to buy $1,000, but in the form of traveling check, not banknote, apparently I pay less. So dealing with banknote and coins is quite expensive, right? Dealing with banknotes and coins, right? It is quite expensive, right? No wonder a lot of countries try to move to what they call cashless society. Don't forget, right, for bank branches to have banknote in foreign currency, they have to keep it, right, at the branches. That means there is no interest earned for the bank. Furthermore, at the end of the day, right, they have to hire a truck, right, or someone to move money, right, to the center, right? That's also cost involved, right? Okay, that's one thing I noticed here. Another thing that I noticed, right, is this. If you have 100 US dollar to exchange with bank, but that $100, right, they are all in $1 banknote versus the same amount, $100, but in bigger banknote, right, $100 banknote. The exchange rate that you get is not the same, right? If I have small banknote and I sell to the bank, this is the rate I get. But if I have bigger one and I sell, this is the rate I get. Basically, I get better price in bigger banknote. And when I buy, bank actually charge me less for smaller note than bigger banknote. Quite interesting, huh? That is because I think in Thailand, right, it is easier to find smaller dollar banknote than bigger dollar banknote. It has to do with supply, right? Because we cannot print these banknotes, right? Somebody have to carry in. So I guess this probably reflect the quality of tourists we get. This is just a joke, okay? So basically, in Thailand, right, smaller dollar banknote is quite easier to find than bigger dollar banknote. That's why banks charge both with an art price more expensive, right, for bigger banknote compared to smaller. Okay, I think this has to be with the supply of the banknotes. Okay? This is like you have 5 20 baht notes worth less than if you have $1 baht notes like that. Okay, this will not happen to Thai baht, right? Because we don't have problem with Thai baht except during Chinese New Year, right? Or TT refer to telegraphic transfer. Telegraphic transfer, transfer money via wire, right? Transfer money via wire. Okay, telegraphic transfer. But DD, I have no idea what DD is. I used to know, but I forgot. Okay. Right. I think we better go for a short break. Okay. When we come back, I want to introduce you to this concept of cross exchange rate. Okay. So we go for a 15 minutes break. Okay. So we come back at 10:45. Let me start by sharing the screen first. Okay, here, right, this is a concept, right, called cross exchange rate. Cross exchange rate, right, cross exchange rate refer to exchange rates between two non-US dollar currency. For example, exchange rate between Thai baht and Japanese yen, right? That has no dollar in there, right? So that is an example of a cross exchange rate. So this is an exchange rate between two non-US dollar currencies. Why do we have to talk about this? Reason being that when a customer wants exchange rate between two non-US dollar currency, for example, the customer might want the bank to quote exchange rate between Thai baht and Japanese yen. So if this is a Thai bank, then that would be number of Thai baht per yen, right? Or customer might want the bank to quote exchange rate for British pound, right? Thai baht per pound. So we know that most currency are traded against US dollar in the interbank market. So the trade between Thai baht and yen, right, directly that hardly occur, right, compared to baht against dollar and yen against dollar. So if the bank, right, want the most recent exchange rate between Thai baht and Japanese yen, right, it might be better to cross the rate, right, from dollar yen and dollar baht exchange rate. Because the trading between dollar yen and baht yen occur very often, very liquid compared to the trade between Thai baht and Japanese yen directly. So normally when a customer call bank, right, to quote exchange rate between two non-dollar currency, right, the bank will have to do this cross exchange rate calculation, because if the bank want the most recent rate, better cross from dollar, right? Because the transaction through US dollar is a lot more liquid. Okay, so that's the idea. Now we know that, right? We know that if it is Japanese yen, right? If it is Japanese yen, right? It is quoted against US dollar, right? In European term, right? So dollar and yen is quoted as number of yen per dollar. In the boxes here, down there, right? In the boxes below there, right? In the slide, I write exchange rate as the textbook language, right? Because it is easier to do mathematical manipulation with the kind of quotation. So basically what I do, right? In this part of the slide, right? You have exchange rate from interbank market. That's how they quote, right? But I rewrite them, right? From interbank quotation into textbook quotation, okay? So we know that Thai baht is quoted against dollar in European term, number of baht per dollar. Japanese yen is quoted against dollar in European term as well. Since the final output that we would like to see is number of baht per yen. Therefore, right, if we want to calculate number of baht per yen from dollar baht and dollar yen exchange rate, we will take dollar baht exchange rate, right, number of baht per dollar, then divide by dollar yen exchange rate, which is number of yen per dollar. So once we do this division, you can see that dollar and dollar disappear. We get what we want. So that's one way to cross exchange rate, right? Through a division, right? Now, if the customer would like to see exchange rate between Thai baht and the pound, in Thailand, that would be number of baht per pound, right? The bank will collect dollar baht exchange rate, right, from Reuters system, which is number of baht per dollar. But as for the pound, right, in the interbank market, they quote the pound in American term. So that is number of dollar per pound. So to transform, right, to transform the right-hand side into the left, in this case, I have to cross by multiplication, right? Then dollar and dollar will disappear. And we would get number of baht per pound. So these two boxes imply that when we need to cross exchange rate, right? To get exchange rate between two non-US dollar currencies, right? We either cross by a division, right? Or by multiplication, right? Only two approaches, okay? You just have to pick the right one, right? Now, crossing exchange rate when there is no bid-ask spread is quite simple. You simply just plug in number, right? Complication come when you notice that in actual Reuters screen, right? These rates, they come in pair of bid and ask prices like this. So when there are bid and ask prices for each pair of currency, now it becomes more tricky, right? How to calculate the cross rate with bid and ask prices. Okay. What I will do, right? I will explain some logic first, right? But I don't want to go through that process too much, right? It's quite a waste of time. So after you understand the logic of thinking, right, I will quickly move to the shortcut, right? I have a shortcut for you, right? And when you use shortcut, you hardly make a mistake. But if you use step-by-step procedure, right, there is a high chance that you make a mistake along the way. Okay, but let me explain how the idea is first. Okay? Let's say, right, the customer want to get the exchange rate, right, between Thai baht and Japanese yen. So in Thailand, we call that we treat yen as commodity, right? So we call that yen baht exchange rate. Right? From previous exercise, we know that we need dollar baht and dollar yen exchange rate. Basically, we need these two exchange rate, right? And then we will make a division, right, to get the cross, right? So we have that two rate here. The hard part is that they come in pair, bid and ask. Okay, how do we deal with that? Okay. This is how the bank think about it. Okay, the following diagram show you how the bank think about it. Okay, but after I finish this diagram, I will jump to the shortcut. Okay. First, right, the bank have to think about how to get the bid rate for that. And then how to get the ask price. Okay, let's focus on the bid rate first. Okay, to get the bid rate, basically bid rate, right, of this cross rate, that is the rate that the customer will sell Japanese yen to the bank and receive Thai baht, right? This is the rate that the customer will sell 1 yen to the bank and receive that X number of Thai baht from the bank, right? Now, the way bank think about that transaction is this. Okay, we are looking for the bid rate. Right, this is the way bank think about that transaction. Basically, the customer have to sell 1 yen to the bank first to get dollar. Sell 1 yen to the bank to get dollar, right? So therefore, we know that in that first transaction, we have to use dollar yen exchange rate, right? And the rate that we use must be asked price. Why do I know that it is asked? Because dollar and yen is quoted using dollar as commodity. So in this first transaction, the customer must buy dollar. So therefore, the rate we use must be asked. And after that, right, the customer have to sell dollar to get Thai baht from the bank. So in the second transaction, we have to use dollar baht exchange rate. And that rate must be bid. because in the second transaction, we assume the customer sell dollar back to the bank. So must be bit rate, right? So that's how we know that we have to use dollar yen and dollar baht exchange rate. And that's how we define whether we use bid or ask price for each to make the division. Okay. So from that concept, right, then you can use the three-stage procedure, right? In Thai, we call เทียบบัญญัติประหยัด right? The three-stage procedure, right? To figure out the bit rate, right? Which is here. Okay, but I don't want to go into this, right? It can be quite confusing and you can make a lot of mistakes during this process, okay? I will show you how to do this using a shortcut, right? But this is a concept, okay? This is a concept how banks think about cross exchange rate. No wonder bid-ask spread, right, of an exchange rate between two non-US dollar currency seem to be wider than dollar exchange rate. Because if banks think about cross exchange rate this way, right, the customer pay bid-ask spread 2 times, right? Because banks think about this as 2 transactions, right? Banks think about this as 2 transactions, right? So the customer basically pay 2 times bid-ask spread, right? Dollar will disappear, right? These 2 transactions, right? Dollar will disappear. So in the end, right, if you net that 2 transactions, it is equal to the customer sell 1 yen to get Thai baht. That's the bid rate of yen baht exchange rate. Okay. Now let's go to the shortcut. I think a lot quicker. Okay. There are 2 shortcuts, right? One on page 37. Another one is on the next page, 38. Why do we need 2 pages? Because we have 2 ways to cross, remember, by division versus by multiplication, all right? So I have to show you both, okay? Let's go to page 37 first. Here, right, the customer wants the bank to quote number of Thai baht per yen. So we know that to get number of Thai baht per yen, right, we have to start with number of Thai baht per dollar, right? That is dollar baht exchange rate. Then divide by number of yen per dollar. That is dollar yen exchange rate, right? So what I do is that the exchange rate that will be used as the numerator, I write it first, bid-ask. The exchange rate that will be used as the denominator in the calculation, right? I write it second row, bid-ask. Now we know that to get the final outcome, right, we have to divide the first row by the second row. Now the idea is this. With the numerator, right, you keep bid and ask as they are. So keep the bid and the ask, right, for the numerator as they are. But the denominator that you will use as a division factor, right? The denominator, we have to cross, right? Basically, the ask rate of the denominator must be crossed to divide the bid price of the numerator, right? Same thing for the bid price of the denominator, right? We have to cross that and divide to the ask price of the numerator, right? And then you will get bid and ask, right, between yen and Thai baht. And if you do this, right, you will not make a mistake, right? You might want to compare what I get from page 37 using the shortcut, right, with, or you can't compare because I use different rates. So sorry, I use different rates, right, on page 36, right? I use certain numbers. And when I do the shortcut, I don't know why I changed the number. So you might have to calculate the shortcut yourself, right? Using this set of numbers and see whether you get the same result. You should get the same result. Okay. Another way to cross is by multiplication. So the customer wants the exchange rate between Thai baht and the euro, right? We know that to get baht euro exchange rate, right? We need exchange rate between Thai baht and US dollar first, and also exchange rate between dollar and euro, which is quoted in American term. In this case, right, we have to do multiplication. Quite easy. Bit multiply by bit, you get the bit of the cross rate. Ask multiply by ask, get the cross rate, right, on the ask side. Okay, so that's how we cross exchange rate with bit ask, right? Now, cross exchange rate, right, tell us that, right, the cross exchange rate practice just now, right, it has some implication to us, right? And the implication that I want to show here is that when there are three currencies, right, when there are three currencies like dollar, euro, and pound, right, there could be three different exchange rates. The first is between dollar, number of dollar, right, per pound, right? Second would be number of dollar per euro. And the last would be the exchange rate between the euro and the pound. So with three currencies, we could have three different exchange rates. But from the cross exchange rate calculation just now, we know that with three possible exchange rates, there are only two degrees of freedom. Meaning that if we know the exchange rate, right, between two pairs, any two pairs, the third rate must be consistent. Otherwise, there will be arbitrage opportunity. Right? When we cross, that means the third rate must be consistent with the first two, right? So that implies you have only 2 degrees of freedom, and the last one must be determined by the first two, right? Otherwise, there will be arbitrage opportunity. Especially if that three exchange rates are quoted by three different banks, right? If that three exchange rates are quoted by three different banks, right? That is a high chance that their quotation are not consistent, and therefore we can earn profit. Okay, let's see how that works. Right, this example is called triangular arbitrage. Okay, I assume there are three banks. Barclays, right? Quote exchange rate between dollar and pound. This is dollar and pound. Right, quoted by Barclays. Okay. The second bank is Citibank, right? Quote exchange rate between dollar and the euro. Right, and then we have a third bank, JP Morgan, right? That quote exchange rate between euro and the pound. Okay, well, now we have a situation where there are three currencies, three pair, right, for exchange rates, right? So what I want to know is whether these three banks, right, quotes exchange rates that are consistent with each other, right? We have the situation, right, that I show you here, right? Right, we know that these three exchange rates must be consistent, otherwise people can make profit. So I need to know whether these three exchange rates quoted by the three banks are consistent or not. Okay. Now to check, right? To check, you can pick exchange rates from any two banks and cross, right? And see whether what you cross from the two banks is the same as what you get from the third bank, right? You can pick any two, right? For me, right, for this example, I pick exchange rate from Barclays, right, which is number of dollar per pound, right? And then the other bank I use is Citibank, right, which show us number of dollar per euro. Now, since I want to cross the rate, right, to compare with the one from JP Morgan quote number of euro per pound. So I have to cross the rate from the first two banks, right, to get number of euro per pound. So what I have to do is that I have to take dollar per pound, right, then divide by dollar per euro. Then dollar and dollar will disappear. Euro will go to the numerator and pound remain at the denominator. So I get the result here. This is the cross exchange rate, right, from the first two banks. Right now, I can compare that with the rate from JP Morgan. And you can see that they are not consistent. And therefore, this presents the customer with the profit opportunity, right, called triangular arbitrage. Okay. So the next step is to determine how to make profit, right? The next step is to determine how to make profit. Okay. Now, when I compare these two numbers, right? One from JP Morgan, that is the euro price for a pound. Another one from the first two banks, that also the euro price of a pound, right? But they are not the same. So that means one is too cheap, another one is too expensive. So since the cross rate from the first two banks is higher, right? Therefore, I would say that at the moment, JP Morgan quote the price for the pound that is too cheap. So basically 1.6650 is too cheap for 1 pound. Therefore, to do arbitrage, we will buy low, sell high. So the idea of the arbitrage is that we will use the euro to buy the pound from JP Morgan, right? And pay for each pound, right? 1.6650. Then after we get the pound, we have to sell the pound to get the euro back, but have to do that through the first two banks, right? And then from this calculation, we know that each pound that we sell, right, we will get back 1.6671 euro. And we do the 3 transactions at the same time, right? So basically, I will use euro to buy pound from JP Morgan. Once I get the pound, right, I will sell the pound to Barclays to receive dollar. And once I receive dollar, I sell dollar to buy euro from Citibank. After I finish this, right, I will, from the beginning, I pay 1.6650 per pound, but I receive back 1.6671. So that gap becomes profit for each pound. Okay. The actual numerical value of the profit really depends on how you start your transaction. Okay. Here I start by 1 pound and I calculate profit in terms of euro per pound. Okay. On the next slide, right, I show you how to do all this, right? But in the next slide, I start with 1 euro. Okay, I start with 1 euro. And don't forget, we do these 3 transactions simultaneously. Therefore, there is no issue about time value of money, right? We do 3 transactions at the same time. So that gap represents abnormal profit, right? So arbitrage profit. Okay. Now, what happens if I start with 1 euro instead, right? Rather than start with 1 pound, right? Here I start with 1 euro. Okay. So we know that we have to sell euro and buy pound from JP Morgan, right? And sell the pound through the other 2 banks. right? So if I start with €1, right, I can sell that euro, right, and each 1.6650 euro, I get back £1. Therefore, the amount of pound that we get back would be, right, for 1 million euro, 600,000 pounds that we get back from JP Morgan. Then we sell this pound to Barclays, right, at this rate, right, to get US dollar. So the amount of US dollar that we will get from the second transaction with Barclays is about 926,000 US dollar. Then in the last transaction, we sell that dollar for euro with Citibank at this rate. So we get back 1.0013 million euro, but we start with 1 million. And we do this at the same time. So you can simply ignore the time value of money, right? And that becomes the profit called arbitrage profit, 1,329 euro for each 1 million euro that we enter the arbitrage. Okay, and this kind of opportunity does exist, right? Because sometimes bank, when they quote exchange rate, they didn't check each other, right? So mispricing can occur, right? Okay, next. Triangular arbitrage without bid ask is quite simple, right? Here I show you with bid ask, right? With bid ask, and I want to see whether there is arbitrage opportunity here. I use the same three banks, right? What I change is that now I assume that they quote bid and ask prices. Okay. Let me show you how to do, but not the result. Okay, the result I need you to finish the final calculation yourself. But let me explain to you how to determine, right, whether there is arbitrage opportunity in the case when we have bid and ask spread. Okay. Same procedure, right? We have three banks, three currencies, and three possible exchange rates, right? To check consistency, we can pick any two banks, right? Let me pick Barclays and Citi. So I want to calculate the cross exchange rates, right, between these two banks, right, to compare with JP Morgan. Okay, we know that JP Morgan quote number of pounds per euro. Okay, the other two banks, right? Citibank quote, right? Citibank, right? Quote number of dollar per euro, whereby Barclays quote number of dollar per pound. So if I want the right hand side, right, to be equal to the left, right, what I have to do on the right hand side is that I have to make division, right? I have to make division, right? And then I would get number of pound per euro. So in the cross exchange rate calculation, I should start with the exchange rate from Citibank, right, which is in the numerator. So I should start with 1. Okay, let's put that down. Okay, 1.0, okay, 5.2. That is bit. Okay, ask is 1.0563. We know that we have to divide that rate from Citibank, right? There, right? With the exchange rate from Barclays, which is in the denominator of the cross calculation. So put exchange rate from JP Morgan down. that 1.2365 to 1.2375. Furthermore, we know that if we have to cross by division, we keep the bit and ask of the numerator, right? But for the denominator, we have to cross, right? Ask to divide bit and bit to divide ask, right? And then calculate. Okay, you should get this number. Okay, 0.8526 for the bit. And this is number of pound, right, per euro. Okay, that is the bit. The ask is 8543. Okay. Now we have the cross rate. We have to compare this, right? We have to compare this with the rate in JP Morgan. Okay. Now to determine, right, whether there is arbitrage opportunity or not, right? This is the approach I normally do. Okay. What I normally do is that, right, I will put the rate from the third bank and the cross rate that we just calculate, right, onto a line to see whether the two ranges overlap each other. So from JP first, right? So JP Morgan, right? That is 0.8510, and ask is 0.8518. So that is the range of bid and ask prices. Yes. Not 25, right? So sorry. Okay. Actually, I got 26. I don't know why I wrote 25. Okay, 27, right? Okay, I believe you. 27, okay. But thank you. Okay. And then I will put the cross rate, right, into the range. Okay, thank you. So that is 0.8527 and 8543. Now you can see that the two ranges, they don't overlap each other. It is pound per euro, right? It is pound per euro. In this slide, right? In this slide, the exchange rate between the euro and the pound, right, is quoted as number of pound per euro. I do this quotation here because in the interbank market, right, if we quote between the euro and the pound, right, we always use the euro as commodity. Okay, that's why in this example I switch a little bit, right? The previous example I simply get it from the textbook. This example all these numbers I got it from the textbook, and I don't know why the textbook quote number of euro per pound, because in practice we don't do that. In practice we quote number of pound per euro. Okay, use euro as commodity, right, against the pound. That's why in this example that I do it myself, I change. Okay, right? So you can see that the two ranges do not overlap. And if they don't overlap, that means there is arbitrage opportunity. There is arbitrage opportunity here. This gap. But if the two ranges overlap each other, that means no arbitrage. Okay, it have to. They don't. They have to be no overlapping. Then you can claim that there is arbitrage. Simply buy the euro. Sorry. Correct. Simply buy the euro. So if we buy euro from JP Morgan, we have to use ask price. Right? Buy euro from JP Morgan using the pound. And then sell the pound, right, through the other two banks. So that means we will get the bid price. And therefore that gap represents profit. Okay. So for the final result, I have to leave it to you, right? Because you would start at different points, right? From me, I guess, right? But as long as we do the same kind of calculation and same logic, right? The result must be the same. Okay. So that's how we determine, right, whether there is arbitrage opportunity, right? And in this case, that is. Okay. So you should go to try how much profit you can make. Right. Okay, let's move on. Right? Let's move on. I start to be excited about the time. Right. Let's move on. Forward contract. Okay, we talk about forward contract many times, right? When we talk about IRP, right? Therefore, I don't think I need to explain again, right? What forward contract is. Okay. The thing is that what I need to show you here is how commercial bank come up with a forward exchange rate that they quote to their customers. Okay, I want to show you how, right, bank come up with the rate, right? And in this chapter, right, we have to separate between bid price and ask price, right? So if you go to the next slide, right, this one I show you how commercial bank come up with the bid side of the forward rate. Okay, if you go to the next slide, which look almost exactly the same, right? You should see almost the same, right? The second one show you how bank calculate the ask price, right? I will show you in details, right, how bank come up with the ask price. Okay, with the bid price, I think you just take the formula as given better, right? So I explain to you, right, the logic of coming up with the ask. Bid price actually use the same logic, but take the opposite transaction. That's all. Okay. Okay. Let me start with the story. Okay. Go up to 44. Here, right? I assume that a customer would like to buy dollar 90-day forward. So that means the bank have to fix this rate, right? Number of Thai baht per dollar that the bank is willing to buy, right? So this one, right? Customer want to, the customer want to buy, so the bank have to sell. So the bank have to come up with the forward exchange rate, right? That the bank is willing to sell, right, to the customer. And this rate must be fixed today, right, for future transaction. So if the bank agree to do this transaction with the customer, right, that means in the future, the bank have to deliver $1, right? So the bank have to deliver $1. And the customer must pay F0 baht. Right? And everything must be agreed today, right? But the transaction is settled in the future. Okay. The question is how banks come up with F0. Bank have to give number to F0, right? Today. Okay. The point is that whenever bank sell dollar forward, right? Customer buy, bank sell. Whenever bank sell dollar forward, the bank will face exchange rate risk because the bank have to fix up, right? Have to fix that rate. Let's say if the bank says 30 baht. So if the bank fix the rate at 30 baht, in the future, the customer will come to the bank, knocking on the door, asking for $1 and pay 30 baht fixed. So if exchange rate in the future is higher than 30 baht, that implies the bank have to go and buy dollar in the market at the price higher than 30, but deliver that dollar to the customer and receive only 30 baht, which is fixed, right? And therefore the bank will have a loss from this forward transaction. So the idea is the bank must come up with F0 that doesn't leave exchange rate risk to the bank. Remember, dealer, they are not speculator, right? Dealer, they are not speculator. They just want bid-ask spread. They don't want to speculate. So how could bank come up with F0 without having to face exchange rate risk? Okay, this is how. You have to go to a slide with the ask rate. So in the future, right, the customer buy. So the bank must deliver that $1 and received F0 baht fixed. Right? In order to have no exchange rate risk from this commitment, right? In order to have no exchange rate risk from this commitment, right? Bank should buy dollar now. Because if the bank purchase dollar today, the bank would know the cost of obtaining dollar, right? And therefore, in the future, there is no exchange rate risk left. So when bank think of this transaction, right, the bank will think as that the bank must buy dollar today, right, and then hold that dollar for future delivery. Right? Buying today means the bank know the cost of the dollar today. Therefore, there will be no exchange rate risk. Right? But if the bank were to buy dollar today and keep for future delivery, the bank doesn't have to buy full $1. Because the dollar that the bank purchased today, right, can be invested into dollar deposit and earn interest. Therefore, the bank should purchase the present value of $1 now. So basically use dollar interest rate, right, to discount $1 in the future, right? That would be the amount of US dollar that the bank should purchase today and keep it, right, for future delivery. Now, thinking about this transaction this way, we also know that the interest rate that we shall use for that dollar should be deposit interest rate, right? Deposit interest rate, which is the bid rate, bid interest rate, right? Now, that will be the amount of dollar that the bank should buy now. So if the bank buy that amount of dollar now, right, bank have to pay spot rate. So simply multiply that amount of US dollar by the spot rate. That would be the cost of obtaining dollar in terms of Thai baht. Doing this, right, we know also that the exchange rate that we should use in that transaction should be asked. Because the bank have to buy dollar in the interbank market and keep, right? So buy at the price at the bank want to sell. So that's ask. Dollar interest, we know from the beginning that must be bid. Okay. Right. Now, this amount, which is the cost of obtaining dollar for future delivery, right? And that cost is in terms of Thai baht. But we should not use that as the forward rate. Why? Because our bank have to pay that amount of Thai baht now, but the customer will pay Thai baht to us in the future, right, on delivery date. So to be fair, right, the bank should charge, right, the cost of capital on that amount of Thai baht, right, because bank pay that amount of Thai baht now, but will receive from the customer, right, in the future, right? So what bank will do is that, right, bank will compound that amount of Thai baht using Thai baht interest. So multiply that amount by 1 plus baht interest. So that now we move present value into the future value. And that becomes the basis of forward rate calculation. And if you look at carefully, that is IRP, right? That is IRP, right? But thinking about exchange rate this way, right? We know that if we want to find the ask price for the forward rate, the spot rate must also be asked. Right? Interest rate on the dollar must be bid. Right? How about interest rate on Thai baht? The way we should think about this transaction is that in order to have dollar to deliver to the customer in the future, right? The bank must borrow Thai baht, right? The bank must borrow this money in order to purchase dollar, right? And hold dollar for the customer. So that interest rate for Thai baht, right? To be fair to the bank, should be the ask rate, right? Borrowing interest rate. See, thinking about the transaction this way, right? We know how to build in bid-ask spread into the forward price. Okay. You will notice that, right? The forward rate, right? The bid-ask spread of the forward rate not only contain bid-ask spread from the spot exchange rate, but it also contains the bid-ask spread from the interest rate as well. No wonder if you go back to the table that I showed you earlier this morning, this table, you will notice that as you go further, bid-ask spread, right, from spot to forward, right, bid-ask spread tend to be wider, right? Bid-ask spread of forward, right, will be wider than bid-ask spread of spot. That is because in forward exchange rate, we have not only the bid-ask spread of the spot exchange rate, but we also build in the bid-ask spread of the interest rate, right? Causing spread to be wider, right? Okay, that's how bank come up with the calculation. But in practice, bank doesn't really have to buy dollar and keep, okay? Because what they do in practice is that they will, if they sell dollar forward, most likely they also buy dollar forward from the exporter. So if bank buy and sell dollar forward, then it doesn't really have to hold dollar today, right? But when it comes to calculation, they always have to think it this way. Okay, and this also helps the bank to avoid being arbitraged, right, against as well, right? This is asked, right? If you want to get forward bid, just the opposite, right? Just change bid and ask, that's all. But the rest of the formula look exactly the same. Okay, so the point is, okay, this is the point to remember. If we want to calculate bid rate for the forward, the spot rate that we use must be on the same side, bid as well. Interest rate on home currency, which is in the numerator, must also be on the same side. But interest rate that is used as the division, we take interest rate from the opposite side, we ask. right? So if I want forward ask, spot must be asked. Interest rate in the numerator must also be asked, right? The one that switch is the one in the denominator, right? That's how you remember, okay? Now let's practice, okay? I have here to practice. Here, right, I have spot rate, bid ask. I have interest rates, bid ask as well, okay? But I want you to calculate 6 months forward. Don't forget that interest rate is always quoted as percentage per year. So before we start, I think, right, we better convert that into percentage per period first, right? So that we don't forget later, okay? So that would be 2.05 for the bid, okay? 2.05 and 2.10, right? That's baht interest 6 months. Dollar 6 month interest rate would be 1.65 and 1.70. Okay. Now we have to find forward rate. Okay. I show you how to do the bid rate. Okay, the ask rate, you do it yourself. Okay, we know that the spot rate must come from the same side, which is bid. Right, and then adjust by the interest differential between the two currencies. Right? Since in the exchange rate, right, Thai baht is in the numerator and dollar is in the denominator. So Thai baht interest must be in the numerator as well. So bid, interest rate must also be bid. Okay. Now the denominator, right, dollar interest, right, we have to switch to the other side, right, to ask. Basically, because we use the ask rate of the dollar to make the division, that will actually push the bid rate of the forward a bit lower, right? Make it basically more expensive, right, to sell to the bank. That will cause forward to be having wider bid ask spread. Oops. Okay. 0170. Yeah. Right? The rest you can do yourself. Okay. So then,
อาจารย์ครับ
yes, go ahead, please.
I'm confused the 4.1 and 4.2%. Are they annual interest rate or 6 month interest rate?
It is 6 month interest rate, but when bank quote interest rate, they will always quote per year.
Oh, okay. Thank you.
When you go to the bank, right, to put money into, let's say, 3 months deposit, the bank will also will always tell you that the 3 months deposit rate is 4% per year, right? Okay. In the exam, I use this practice. Okay, so don't forget that percentage is always per year, unless I mention otherwise in the question, right? Okay. Now that's how bank come up with the forward exchange rate. But when the bank want to present the forward exchange rate to the customer, right? There are two ways that the bank presents forward rate to the customer. The first approach is to show full quotation of the forward rate, called outright quotation. The second way that bank use, right, is to show customer spot exchange rate plus another number called swap point. And this is called swap point quotation. right? And basically the two approaches give the same forward rate. It's just that with outright quotation, the bank show the forward rate in full. With swap point quotation, the bank give two numbers, spot exchange rate now, and the part that we use to adjust spot rate into the forward rate. That is called swap point. So the customer can simply sum up these two numbers to get the forward rate. Swap point simply reflect interest differential, right? Swap point simply reflect interest differential. Swap point can be positive or negative, right? Depends on which currency has higher interest rate. Okay, let me show you how that is done. Okay. Assume, right, you call the bank, asking the bank, right? You ask the bank to quote 1 month forward and 3 months forward for you. So I assume that this bank use swap point quotation, right? This bank use swap point quotation to quote the exchange rate back to the customer. So if you want 3 months, 1 month forward and 3 month forward rates, right? The bank will give you spot rate first, and then attach with something called swap point, right? Since you want 1 month and 3 months forward, therefore the bank will give you both 1 month and 3 months swap point, bid and ask. So if we want to get outright quotation for the forward rate 1 month, simply add swap point to the spot rate, bid to bid, ask to ask. You get full forward rate quotation that is called outright, right? So if we want 3 months forward, simply add 3 months swap point to the spot rate. We get 3 months outright forward rate. Okay. To me, right? To me, I prefer swap point quotation. They actually give you exactly this. They give you the same information, right? It doesn't matter which way the bank use, right? The customer get the same information and the same rate anyway. But for me, right, I prefer. I prefer swap point quotation in a sense that with swap point quotation, the customer will understand straight away that whether the forward rate is 1 month or 3 months, they come from the same spot exchange rate, right? Whether the forward rate is 3 months, 1 month, right? They come from the same spot rate. The part that make forward 1 month and 3 months to be different is the swap point. And that swap point reflects interest differential. Therefore, to me, right, this kind of quotation kind of educates, right? Educate customer, right? That the reason why forward rate and spot rate are not the same, right, is because of interest rate differential, right? That come in the form of swap point here. Okay. Apparently, if you are a big customer to the bank, right, swap point quotation is the one that bank give to you, right? Okay. Here, right, I just give you as a practice, right? So you can practice here. Here, right, I have spot exchange rate, right, and swap point for 3 different tenors or time to maturity, right? The first example on this slide, we have positive swap point. So when you combine with spot rate to get outright forward, so the last column here, the one on the right hand side, that is outright exchange rate. You can see that forward is more expensive than spot. That is because of positive swap point, which imply which interest rate is higher. Anybody can tell me? We are going to have exam next week. So when swap point is positive, that implies, yes, I got the answer here. That's right. Thai baht interest rate is higher. Right? That's why dollar forward must compensate for lower interest rate, right? By being higher, right? Okay, right. Second example show you the case when swap point is negative. Okay, but the rest are the same. So when swap point is negative, right, forward will be at a discount. Okay, so I leave the detail to you, right? Now I have last example that I will not show you how to do it. Okay, you practice this yourself. Okay, you practice this yourself. This is cover interest arbitrage, but this time it is a bit more complicated because we have bid and ask prices. Okay, right. I want to leave that to you to do it yourself. Okay. Right. I have about 10 minutes left. Please allow me to go to the next topic. Right. I just want to cover a few slides only. Right. So that we are at par with the other class. Okay, let me move on to the next topic, right? I want to cover just a few slides. In this topic, right, I want to introduce you to a contract, right? Okay, now it's coming. A group of contracts, right, known as derivative contract, right? And I want to talk about two kind of derivative contract, right? One with those that have foreign currency as the underlying asset. Another contract has interest rate as the underlying assets. Okay, so I will cover something like FX forward, FX option, interest rate swap, cross currency swap, right, in this topic, right? But since we are talking about FX forward just now, so I think it's better that I just talk about forward in this lecture as well, so that we finish the forward. So when we come back from the exam, we start with FX option, okay? So I just want to complete that part, right? Since we are talking about it anyway, right? Okay, quickly. When counterparty, right, want to write FX forward contract, right? These are conditions that the counterparty have to agree upon when writing forward contract, right? First, we have to write the agreement date, right? When do we enter the contract, right? Second, in the contract must state who is the buyer, who is the seller of the foreign currency, right? It must mention the name of the foreign currency and the amount under the contract. The foreign currency under this contract, right, we call that as the underlying asset. The amount of foreign currency under the contract, that is the size, right? That is the magnitude, the size of the contract, right? Then counterparty must agree on the time to delivery, the date that the contract must be settled, called delivery date. And the last piece of agreement is on the exchange rate, right? All this has to be agreed first. The exchange rate under the contract is the final piece of information. I should say the final piece of the contract condition that must be negotiated, right? And the exchange rate in this contract is called the forward exchange rate. Okay, now when we enter into a forward contract, right, the forward contract itself is risky, right? Basically, if we buy dollar forward, right, if we buy dollar forward, and in the future the exchange rate, right, is higher than the forward rate that we purchase, right? That difference between the forward rate and the exchange rate in the future represent gain, right, from the contract, right? But if the exchange rate in the future is less than the forward rate, right, the difference represents loss from the contract. So what I want to show here is that forward contract itself is risky, right? If we enter the forward contract, whether we buy or sell, right? There is a chance that we might lose money from the contract, but we can also gain from the contract. So the forward contract itself is risky for both seller and buyer. But the point is, we will use this contract for hedging. We will use this contract for hedging. The idea of hedging is that we have a risky position. We will create another risky position in such a way that when we combine them, right, the risks cancel each other. Okay, so here, right, I want to point that forward contract itself is risky, right? Create exchange rate risk for those enter into the contract, right? But we can use this kind of instrument to hedge our existing position, right? That is risky as well, in a sense that the two risks combined cancel each other. Okay, later on when we come back, I show you, and then I want to compare this kind of contract with option as well, right? But before we go to that, right, let me show you, right, how to make use of forward exchange rate, right, for corporate decision, right, on this slide. Okay. Here, right, I have spot exchange rate, right, and 1 month, 2 months swap point, right? So let's put that into outright forward first. So bid would be 30.80. Ask would be 31.55. Okay, now put the 2 months as well. That would be 30, right? 0.62. Nope, 72. And 31.50. Okay, right? Let's do the first exercise. This one. This is a Thai firm, right? The cost of production is 50,000. So the firm, right, is an exporter, and the firm would like to have at least 10% margin. So if the firm were to quote Thai baht price of this product, it's going to be 50,000, right? Multiplied by 1 plus profit margin. That would be 55,000. The tricky part of this is that this firm must quote dollar price, not Thai baht price, right? This firm must, in this case, right, dollar interest is higher than baht interest, right? In this example, it implies that today dollar interest rate is actually higher than the Thai baht interest rate. That's why we have forward discount. Okay, so the tricky part is that this firm have to quote dollar price. We know that we have to use exchange rate to make the division to the baht price, right? But there's one more trick. I mean, there's one more tricky point. That is, not only the firm have to quote dollar price. When the firm sell products, the firm also give 2 months credit term to the customer. So the point is, which exchange rate shall I use to convert the baht price to US dollar? Right, which one? There are 6 exchange rates here given to you. So which rate shall we use to convert dollar price into baht price into dollar price? Okay, the first thing is bid or ask. Shall we use bid or ask exchange rate for that price? After the exporter received dollar from the customer, the exporter have to sell dollar for Thai baht. So the exporter will face the bid side of the transaction, right? So it must be bid, okay? Must be bid. Now, which rate shall we use? Spot, 1 month or 2 months forward. We shall not use spot because the exporter will not get the money now. The exporter will get the money in 2 months' time. So actually the appropriate exchange rate that we shall use in that pricing should be expected exchange rate in 2 months' time. But if we were to use expected exchange rate, we have to force the exporter to forecast the exchange rate. But if the exporter doesn't want to forecast exchange rate, want to use existing market information, right? I think the best way is to use forward exchange rate. 30.72. And that will result in, okay, can you give me the number? I forgot to write that down. I did this many times, but I always forget to put the number down on my slide. Oops. So that 5,500 divided by 30.72. So that is 1,790, right? Yes. Okay, we all agree. 90. So that should be the price the exporter quote. Now, if the exporter quote this price and the customer agree to buy, do you think the exporter can lock in this 10% margin today? Let's say the customer agreed to buy. So if the exporter quote that price, could the exporter make sure that in the future it will earn 10% for sure, assuming the customer will not default? Okay. The customer can, the firm can, right? Basically, once the customer agree to buy the product, right? This exporter go to the bank, tell the bank that I want to sell dollar forward 2 months. This is the rate that the bank gives the customer, the exporter, which is the same rate here. So that means if we move that one to this side, by selling dollar forward, our exporter ensure that it will get 10% margin for sure in the future. So this is why I suggest to use forward exchange rate for determining the price, because that is the rate that we can actually lock in today. Okay, so that's an application of the forward exchange rate, right, for pricing, right, for pricing purposes, right? But in practice, if the competition is high, and when the exporter quote this price, the customer might not want to buy, right? Because other competitor quote cheaper. So in that case, right, this firm might need to quote a cheaper price. But this practice tells us that if the exporter quote the price cheaper than 1,790, right, and it still want to get 10% margin, then it shall not hedge, right? That means the exporter now have to bet on the exchange rate in the future, whether it get 10% or not. Because if you quote price cheaper than 1,790, right, and you hedge at 30.72, right, when you convert to Thai baht, that will be less than 55,000, so less than 10% margin. Okay, so if competition force the firm to quote lower price than what suggested there, and if the firm still want 10% margin, then the firm have to leave the risk open, right? And also have the chance of earning even less, right? But could earn more as well. Okay. I think I want to stop here. I don't want to spend too much of your time, right? The second example here, right? You have to use the ARS exchange rate, right? This second example, use the ARS rate 1 month, right? 1 month, so which is this one. Okay, use that one for this example. Right. Okay, I think I want to stop here, right? Before we end the class, right? Do you have anything you would like to ask first? In the exam, right? You have to log into the Zoom meeting. So I will create that Zoom meeting room soon. Okay, I'm still learning how to do it, right? And then you can download the question paper from Blackboard. Okay, I will turn on that right at 9 o'clock on the exam date. Don't forget, you should log into Zoom meeting about 30 minutes before the exam time, right? Because we have to check your attendance, right? We have to check that you are the real, you are you basically, right? I want to check that you are you doing the exam, okay? So I might ask you to show your student ID, right? To make sure that it's you. And upon entering the Zoom meeting, all right, I will ask you to change your name, right, in the Zoom meeting, right, by adding the seat number in front, right, adding seat number in front of your name, right, so that make it easier for us to invigilate, okay. The seat number will be announced on Blackboard sometime this week, okay, once I learn how to set the Zoom meeting. That's right. The exam must be, I mean, your answer must be written on hard paper, right? On paper, not iPad. Okay. Because some students will, not all. I mean, basically, we want to restrict you from using communication devices. That's why I need every student to write answer on paper. Okay, not iPad. Homework number 3. Okay, if I have time, I will do the guideline for you. Okay, if I have time, but I'm not sure whether I will have time to do that. Right? How should? Okay, the camera, right? If you have, let me try. Okay, let me try logging in this Zoom to show you. If you have a camera, right, a separate camera that you can put the camera from the mobile phone, right, on the side. Just give me a second. It's entering. Okay, you can see me, right? If you put the mobile phone, right, I guess, like that will be fine enough. I think at least we can say that you are not using communication devices. Okay, just try to make it fair to all students, right? But if you use the camera in front of the computer, like the one I have here, this one, you harder to set. I don't know. You just try your best, right, to set up such that we can tell that you are doing your work, right, not searching the internet, okay, or talking to your friend, right? Pencil is okay, but make sure that it is clear enough, right, when I print it out. Yeah. The exam is only 2 hours. Okay, there'll be 4 questions, only 4 questions. That there could be sub questions, but normally I use sub questions so that you follow the process of answering, right? Okay. Any more questions? Okay. Don't forget that you have to. That's right. The exam will cover until right after the end just now, right? Until the last example just now. Right? The exam cover until that. Okay. Basically part of lecture 7 as well. Okay. If you are not familiar with taking photo of your answer sheet and convert right into one PDF file, right? You might want to practice first. Okay. For me, I have to practice because I'm not familiar with that, right? Review class. I think for midterm probably not, but for final exam, I will have enough time to review with you. But this is the last class, and then we just have the midterm. Okay. Would it be enough to only read my slides? I prefer you to read the textbook as well. Okay, but really it depends on whether you have enough time, right? So I wouldn't say that it is enough just to read my lecture notes, right? Because that defeats the purpose of having the textbook, right? So please do not force me to answer that question, okay? Because if I answer, I would say, no, you should read the textbook as well. Okay, I think, okay, one more. Huh? Until now, you haven't received the code for the textbook. What happened? Oh, okay. Oh, I have no idea why that happened. I actually checked with the program about the textbook before we start the term, and they said everything is okay. Even me, I also get the textbook from the publisher, so I thought everything is fine with the textbook now. Okay. With the textbook, I'm not sure how. But I wouldn't say I mean, if you have access to textbook, let me say this. If you have access to textbook, I recommend you to read the textbook, okay? Reading my lecture note, I don't think you learn much, okay? You learn more if you read the textbook, okay? So that's what I recommend you to do, okay? But when I write the question, I will take this information into consideration. That's right. During the exam, right, you are not allowed to use any communication devices. So if you use calculator, it must be standalone calculator. Okay. I just try to make it fair to all students, right, for the exam. Right. That's right. You only use computer to look at the exam question. That's correct. And use the mobile phone just to log into the Zoom meeting. Correct. If you notice the course syllabus, right, I actually have a reference, right, chapter to the textbook. So basically just read according to that reference, okay? And normally if you have the textbook, I would expect you to read the book along the way, not just in the last week. That's why I thought you have enough time to read the book, right? Of course, if you don't have enough time, then you have to manage. This is called crisis management, right? If you don't have enough time. So in that case, I can't give you suggestion, you see, how to do with the crisis management, right? Because I should encourage you to read the book from the beginning, right? You should understand my role, right? As a lecturer, I should encourage you to read the book from the beginning, right? Therefore, please don't force me to answer this kind of question, right? Okay, so you should read all, okay, if I have to answer, right? But of course, with limited time, now you have to manage, okay? Okay. Any more questions? Right. If there's no more question, then I will meet you in the exam, okay, exam room, right? I will post the Zoom meeting on Blackboard the same way I post the lecture meeting, right? So you can see that. Tomorrow I will get somebody to teach me. I actually learned how to do it, but still not sure about certain function in Zoom. So I have to learn first tomorrow, okay? And then I post it on Blackboard, right? Okay, I see you again, right, in the exam. Okay, and after the exam, I will also arrange all the Zoom meeting for the second half, right? Okay, that's it for today. So see you again next week, right? And good luck to all of you. Okay.
อาจารย์คะ
ครับผม
I'd like to ask a question for the calculation of like IRP or arbitrage for IRP and like the lecture from the last lesson. Do we have to power up with time? For example, with like 9-month contract, do we have to power?
Normally, if the time period is less than 1 year, we assume annual percentage rate. So if the interest rate is say 12% for 9 months per year, but for 9 months, simply multiply 12% by 9 over 12. Right? But once the period is longer than 1 year, then we normally assume effective annual rate that when you have to take to the power. But in the exam, if you take power even with shorter than 1 year, I don't mind. Okay.
Oh, so it could be the rate that is already multiplied by the term of the time and could be power or not power ก็ได้ทั้งคู่เลยใช่ไหมคะ
That's right. Yes. You basically when you multiply, that is called simple compounding. When you take to the power, that is called effective compounding. So I don't mind which approach you use, right? I mark both of them as correct. Okay.
I see, but the last time I did the homework, I tried both way and it gave different answer. Like there was one question, if I don't remember wrong, it gave the difference of like around 100.
Oh, that means the principal must be quite big, right? That's why that's the result be different because one you assume compounding effect, another one you assume no compounding effect. That's why the result be different. So normally I would have two set of answer in my solution, right?
Okay,
right.
I see.
So make sure that when you write answer, it is easier for me to track because sometimes students write a lot of things until very hard for me to track where the answer is. That when I might be able, I might mark it wrongly. Okay. So if the answer is written neatly and easier for me to track where the answer is, right? Then I normally have two set of answer that I mark both as correct. Okay.
I see. And does this apply to like with like every calculating question? That has like
not really. Normally, I prefer, right, if it's less than 1 year, money market use simple compounding. But there will be a small group of students that take into the power. But in that case, I normally do not penalize. I mark it as correct. Okay, so that applies to most of the case, right? But that there might be exception, but I can't think of it at this moment, right? But let's say apply to most of the cases.
I see. Thank you ค่ะอาจารย์
ครับผม
อาจารย์คะ for the exam how do we submit it? Do we like just submit it like homework?
That's correct. Yes, do the same as a homework. That's right.
Okay ค่ะ Thank you ค่ะ
อาจารย์ครับ like do we have extra time to submit the
10
exam
minutes.
or okay
10 minutes. So exam end at say 11, then I will give you until 11:10 to submit.
okay ครับ and will you upload the answer for homework 1 or homework 2?
Homework 1 and 2 already. You mean the solution?
Yeah.
Oh, I will not give written solution, but I discussed about the solution in previous classes. I think number 1 and number 2.
Yeah. Oh.
So So it
Okay,
will not be
okay.
in written form. Okay.
โอเค โอเค
ครับ
thank you ครับอาจารย์
Acha, from my understanding, there will be another homework this Friday, right?
That's correct. Yes, I have written it and I will release it on Friday. That's right.
And
And this should be a good practice before the exam. Okay.
and will you provide the answer for the last week's and this week homework as well?
If I have
before
time, I will. If I have time, but this term I'm terribly busy, right? If I have time, I will do, but I can't promise, right? I can't promise. This term just killing me because of a lot of work to do, right? Including marking your papers. If I have time, I will write the solution up, but I might not. I might not. Okay. But I found that the homework number three, probably only the first question is a bit tricky, right? The rest are not that difficult, right? And the first question is something that I do not ask in the exam. It's a bit tricky, okay? I will answer the first question once we come back, right? For the third homework. The mean score for homework number three, I have not marked yet. I just got it from you on Monday, right? And I just finished marking another set of students, my master's students, right? I also have homework to mark this morning. So once I have time, I will come back to mark yours, right? Okay, I have about 80 students in this class, right? And then I have another 90 in master and another 30 in another subject. So marking your homework is killing me at the moment, right? I try my best, right, to do that. So homework three, I hope that I can do it before your exam, right? And I will release the score, right? But I can't promise, okay?
Ajahn, if it's possible, can you release the homework faster? So like we can
I
have
can't.
time
I'm so
to
sorry.
prepare
If
other
I can,
subjects.
as I told you, there's so marking for me to do. I just finished 90 students for another subject, and I have other commitment as well. So and marking from the screen is quite difficult. You know, this class, right? I spent about 2 days, right, to mark the just the homework, each homework. So it's not that easy, but I try to do my best. Okay, I'm not sure whether I would be able to do it, but I try my best to release the score as quick as I can. Right, but please don't make me promise on that. Okay.
I mean the homework, not the
Yeah.
score, just the homework, like the question for
Oh, you mean the
homework
question?
number 4.
The question.
Yes.
You know why I give you limited time? That has to be past behavior of students, right? In the past, right, I give longer time, but I found when I give long time, right, students copy from each other, and that put me down quite a little, right? For that, I spent a lot of time thinking about questions, what to ask, and in the end, a lot of students just copy from each other. That's why I become, you know, as time passes by, I become more and more strict, okay? And that's why I only give you limited time, because giving more time, students tend to, you know, copy from each other. Okay, so but this time, okay, I can't change for this coming homework because I announced that with the previous class already. So with this particular homework is still on Friday. If we want to have new arrangement, we can do it after the midterm. Okay. Midterm score after homework 3 score after the midterm. Okay, right. Okay, so I think that's it, right? You might have another class later on. Okay, so have a good luck, right, to all of you, right, with all the exams you have. Okay, I see you on the exam date, right? Good luck. Bye bye to all of you.